Welcome back to RE Mastery Hub. Lesson 9, Insurance Principles. Every insurance contract in South Africa, life cover, car insurance, home insurance, is built on the same 6 ideas. Once you understand these 6, you understand why claims get paid, why claims get refused, and why you can't just insure anything you like. We're going to keep this simple. Plain English, real examples, and one worked calculation you will definitely see in your exam. After this lesson, you will be able to 1. Name all 6 principles in plain words. 2. Explain why indemnity applies to short-term but not life insurance. 3. State when insurable interest must exist. 4. Explain subrogation and contribution. 5. Apply the proximate cause test. 6. Calculate a claim payout using the average clause formula. Principle 1. Indemnity. In plain words, insurance is meant to put you back where you were before the loss happened. Not better off, not worse off. Just back to where you started. This applies to short-term insurance, your car, your home, your business. If your car is damaged, the payout restores its value. It doesn't make you a profit. But indemnity does not apply to life insurance. Life insurance is what's called a valued policy. It pays a fixed amount that was agreed when you took out the policy, regardless of your actual financial loss. You can't measure the financial loss of a life in the same way. Exam trap. The exam will ask if indemnity applies to a life policy. It does not. Life insurance is valued, not indemnity-based. Principle 2. Insurable interest. In plain words, you can only insure something if losing it would genuinely hurt you financially. You can't insure your neighbor's car just because you like it. You have no financial stake in it. When must this interest exist? It depends on the policy type. For long-term insurance, like life cover, insurable interest only needs to exist when the policy starts, at inception. For short-term insurance, like car or home insurance, insurable interest must exist both at inception and again at the time of the claim. Exam trap. If you sell your insured car, your insurable interest ends immediately, even if the policy technically continues. Principle 3. Utmost good faith. In plain words, both sides must tell the truth. This is not just the client's responsibility. The insurer has this duty too. A material fact is anything that would change the insurer's decision, whether to offer cover at all or what premium to charge. The client's duty: disclose health conditions, past claims, and risk factors, even if the insurer doesn't specifically ask about them. The insurer's duty: disclose the terms, exclusions, and limits of the policy clearly, so the client actually understands what they're buying. Exam trap. Students often think this duty only applies to the client. It applies to both parties. Breaking it on either side can make the contract void. Principles 4 and 5. Subrogation and contribution. These two work together and both only apply to indemnity-based insurance, never to life insurance. Subrogation. After the insurer pays your claim, they take over your right to recover money from whoever actually caused the loss. Example: someone crashes into your car. Your insurer pays you, then pursues the other driver's insurer to recover that money. Contribution. When 2 or more insurers cover the same risk, each pays only their proportionate share. Example: if your car is accidentally insured under 2 separate policies, both insurers split the claim between them. You don't get paid the full amount twice. Exam trap. Both of these principles only apply to indemnity policies. They never apply to life insurance because life insurance isn't indemnity-based in the first place. Principle 6. Proximate cause. In plain words, when there's more than one cause of a loss, the insurer looks at the main, most direct cause, not just the last thing that happened. SA example: lightning strikes a building and weakens a wall. A few days later, strong wind blows the already weakened wall down. What caused the loss? The proximate cause is the lightning because that's what actually weakened the wall in the first place. The wind was just the final trigger for something the lightning had already set in motion. Exam trap. If the proximate cause turns out to be something excluded from the policy, say the policy excludes lightning damage, the claim gets refused entirely, even though wind damage might normally be covered. The average clause. This is the one calculation the exam actually wants you to do. The formula: payout equals sum insured, divided by actual value, multiplied by the loss amount. SA example. Lorado insures her shop for 500,000 Rand, but the shop's real replacement value is 1 million Rand, meaning she's 50% underinsured. A fire then causes 200,000 Rand in damage. Working through the formula, 500,000 Rand divided by 1 million Rand, multiplied by 200,000 Rand equals 100,000 Rand. Lorado only receives 100,000 Rand, not the full 200,000 Rand she lost. She has to cover the remaining 100,000 Rand herself because she chose to underinsure. Exam trap. The sum insured must reflect replacement value, what it would actually cost to replace the item today, not what was originally paid for it years ago. 6 exam tips for insurance principles. Tip 1. Indemnity applies to short-term only. Life is a valued policy. Tip 2. Insurable interest timing differs by policy type. Tip 3. Utmost good faith applies to both sides. Tip 4. Subrogation and contribution never apply to life insurance. Tip 5. Proximate cause is the main direct cause. Check if it's excluded. Tip 6. Memorize the average clause formula exactly. Your one-screen summary. Screenshot this slide. Come back to it the night before your exam. Top left, indemnity and insurable interest. Top right, utmost good faith, subrogation, and contribution. Bottom left, proximate cause. Bottom right, the average clause formula. Bottom strip, the 2 facts most tested on this topic. Pause and answer the question on screen. Which insurance principle does not apply to life insurance policies? The answer is C, indemnity. Life insurance is a valued policy. It pays a fixed pre-agreed sum when the insured event happens, regardless of the actual financial loss suffered. Indemnity is about restoring actual financial loss, which simply doesn't apply to life cover. Insurable interest, utmost good faith, and proximate cause all still apply to life insurance. Second question. Pause and answer. SIPO insures his factory for 800,000 Rand. Its actual replacement value is 2 million Rand. A fire causes 400,000 Rand damage. What does he receive? The answer is B, 160,000 Rand. Using the average clause formula, sum insured divided by actual value, multiplied by the loss amount. 800,000 Rand divided by 2 million Rand, multiplied by 400,000 Rand equals 160,000 Rand. SIPO was 60% underinsured, so he only receives 40% of his actual loss. He must find the remaining 240,000 Rand himself. The average clause exists precisely to discourage underinsurance. Quick recap. 6 things. 1. Indemnity restores pre-loss position, not life insurance. 2. Insurable interest timing differs by policy type. 3. Utmost good faith is two-way. 4. Subrogation recovers from the at-fault party. 5. Contribution splits the claim between insurers. 6. The average clause formula and why underinsurance costs you money. Quiz this topic on RE Mastery Hub now. Free to start. Upgrade when you are ready. Next lesson, long-term insurance products. the different classes and categories you'll be tested on. Subscribe. Study smart, pass first time. See you soon.